On Friday, Silicon Valley Bank, which provided banking services to nearly half of the country's venture capital-backed technology and life science companies, failed. The bank invested most of its deposits in long-term debt like Treasury bonds, which looked attractive when interest rates were low. However, when the Federal Reserve raised interest rates to combat inflation, Silicon Valley Bank's investments looked less attractive, and it was left with significant losses. The bank's concentration in the tech industry also contributed to its downfall as startup funding decreased, leading its clients to tap their accounts more frequently. Moreover, the bank had many uninsured depositors who withdrew their money during turbulence, leading to a bank run. As a result, the Federal Deposit Insurance Corporation took over the institution, putting about $175 billion in customer deposits under its control. 2 days later, New York regulators closed Signature Bank, which had taken deposits of crypto assets after the industry's collapse. Like Silicon Valley Bank, most of Signature Bank's customers had more than $250,000 in their accounts, and close to 9/10 of the bank's roughly $88 billion in deposits were uninsured at the end of last year. As Silicon Valley Bank's troubles spread, many of Signature's customers panicked and began calling the bank, leading to a torrent of deposits leaving its coffers. Regulators have been rushing to contain the fallout from the collapse of 2 banks in 3 days, prompting a swift re-evaluation of the Fed's interest rate increases. The Fed had been expected to make a half-point increase at its next meeting before the bank's collapse. However, regulators assured depositors that they would be made whole regardless of how much they held in their accounts and would have full access to their money. Some people compare the current situation to the 2008 financial crisis. And you, what do you think?